Happy New Year, everybody. I hope you had a great start to 2022. I'm joined today by Melissa from our Claremont office. She is an advisor and specializes in real estate. And as we look at 2021, look back a little bit, we look at the Dow Jones, which was up 18%, a little bit more than 18% for 2021, and the Nasdaq was up a little more than 21% for 2021. So definitely much bigger returns than what we kind of anticipated. Thought maybe things would be a little over 10% for this year, and definitely they took off, especially towards the end of the year. And another thing that we really look at is interest rates. When you look at interest rates back at the beginning of 2021, they were 0.91 on the 10-year, so less than 1%. And as we finished 2021, they were sitting at 1.5. So definitely had a nice little increase in interest rates, or the 10-year Treasury. And when we think about interest rates, we always think about real estate. So Melissa, what are you seeing in real estate right now?
Yeah, so talking about interest rates, as Henry mentioned, we see that those might be ticking up, and interest rates for your standard conventional 30-year mortgage on homes follows the 10-year Treasury. They've been projected to increase to potentially 3.5 or so by the end of 2022. So that's what we're seeing. There's also been projections that the housing market for this year could be even potentially crazier than last year, but at least solid nonetheless. A few reasons for that is, one, we are seeing a supply crisis. So in Southern California alone, there's less than 17,000 homes on the market. So it's a record low. So we're still having that problem with inventory. Other reasons that we are projecting a strong housing market this year is that demand is going to continue to increase. Even with the interest rates going up, we have a few other factors that are increasing demand. One of the reasons that we're seeing demand most likely increase this year is that they increased the loan limits. So that allows more people to get into the buyer pool, creating more demand. Secondly, we're seeing that this is the strongest demand demographic. 32 is kind of that prime age for home buying, for some home buying. And so with the millennial generation being so large, there's so many of them getting into the market. So that is naturally increasing demand. The third reason why we are seeing demand increase this year is that there's so much cash on hand. As Henry has mentioned in past videos, the amount of money in savings has increased. So what we're seeing is a lot of parents helping out the younger generation, bridging that gap from what an appraisal might come in for the value of a home to what it is actually getting sold at. And the fourth point, kind of interestingly, we're seeing a lot of, about 20% according to a recent survey done, a lot of people that have invested in cryptocurrencies taking that profit and using it as a down payment for homes. So all of these factors are just adding to the demand, again, with low supply, keeping the market, housing market strong for 2022. So Henry, with that, what other headwinds are we seeing in the market for this year?
Well, really, the headwinds that we'll be facing are some things that we've already been talking about a lot at the end of last year. And it comes down to really two major items, and that would be interest rates and the inflation. And if we really look at that, let's take interest rates first. We really think that the Fed will be raising interest rates 3 times in 2022, and that will be in June, the end of summer, so let's say September, October, and December. And if the Fed moves quicker, or if they do more than a quarter point increase in each one of those increases, say like a half a point, that's going to spook the market. And so that could really be some big headwinds heading into the second half of the year. The other thing that will be happening is the Fed will be tapering their bond buying for the first half of the year, and that will also affect interest rates, probably start to gradually let them creep higher going into the first and second quarter. So we're watching that real heavily and making sure, obviously, that there isn't any big changes when it comes to Fed policy. Inflation, which was what would be causing that change, is something that we're definitely keeping an eye on. Everybody had been reporting that inflation was going to be transitory. We said, no, we don't think that that's the case. It's not temporary. It's here for a while, and that's actually what's taken place right now. And we continue to see inflationary pressures from a number of different reasons happening in 2022, whether it's a lot of buyers like the housing market, or a lot of cash in the system, and supply chains on the other side of things being continue to be shut down or narrowed, and so there just isn't the supply of goods getting out there. The thing that we're really watching is wage inflation. If you look back in the 1970s, 1980s, wages started to go up, and then that goes directly to prices going higher, which then pushes wages higher, and then prices, and you get in this cycle. And we're not there yet, but we are watching to see if that was something that may take place, where you go back and forth between wages going higher and prices going higher, and that can kind of spiral upward. That's something else that could definitely affect the market in 2022. What we're doing is we are kind of taking money out of our growth stock portfolios. Growth stocks versus value stocks have really separated a very big margin, the biggest margin since 1999 or the tech bust. And so we don't think we're back there, but we are taking some profits, taking some money out of technology, out of growth stocks, and only keeping the most highest quality growth stocks and adding more to the value side of our portfolio. So kind of a barbell approach. Still keeping growth in the portfolio, but also adding more value to the portfolio for 2022. So you'll be seeing those changes in your accounts over January, February of this year. The other item that is kind of interesting, kind of a little quirky thing, is the second year of a presidential election. Usually the first year is really good. The second year is the worst performing typically of the 4 years, and then the third year, which will be next year, is usually the best performing. Once again, does that happen every time? By no means, but it is something that's kind of interesting to look at. Other than that, we really look forward to doing annual reviews with everybody over the next few months, and we definitely hope everybody's having a great start to their new year. Look forward to talking to you later. Thank you.